Ladies and gentlemen, welcome back to another episode of Investing for the Common Man. My name is Luke, and my mission is to help you save not just your money, but more importantly, your time. Today, I just want to break down some of the vocabulary and lingo that you might encounter if you start following markets and read financial headlines and articles. I also want this to be an easy reference video for a lot of the vocabulary I'll be using often here on the channel. As always, please don't forget to like and subscribe. The first two terms I'd like to discuss are equities and securities. Equity refers to a form of ownership in a firm, either by investing capital or purchasing shares in the company. The term securities, on the other hand, is much broader in nature and can refer to a broader set of financial assets, including banknotes, bonds, stocks, futures, options, etc. Investors purchase securities in hope of later selling them after they have appreciated in value. Next, let's look at the terms bullish versus bearish. These two terms are used to discuss the forward-looking sentiment of investors on specific securities. Investors who speculate that a specific security will increase in value can be referred to as bulls, and those who believe the security will decrease in value are bears. These terms can be used as both nouns and adjectives. You can also refer to the current market trend as a bull market or a bear market. I always used to mix these up, so I use this trick to keep them straight. Bulls, when provoked, charge forward, while a mama grizzly bear will back up and become defensive of her cubs when provoked. In the world of investing, speculation is exactly what it sounds like, forming a theory of conjecture on how asset values will fluctuate in the future without firm evidence. Speculation in financial markets can seem a bit like gambling, but traders have a massive amount of information and data available to them to help them form theories about what might happen. Many traders will also speculate using purely mathematical and statistical probabilities to inform their trading. In addition to bears and bulls, we have a couple other animals to add to the mix. You might occasionally hear economists talk about the monetary policymakers from the Federal Reserve as dovish or hawkish. Dovish policies involve the lowering of various interest rates to encourage spending and stimulate economic growth, while hawkish policies, on the other hand, involve the raising of interest rates. Hawkish monetary policies aim at slowing down economic growth and preventing excessive inflation. Right now, we have a dovish Fed that just slashed interest rates to 0% in an attempt to stave off a recession while the world is fighting COVID-19. Next, let's talk about derivatives. Derivatives are securities whose value relies on the fluctuations of an underlying security. Derivatives generally take the form of contracts that an investor can purchase and in return receive certain rights regarding the underlying security. Derivatives are useful because they can allow buyers to lock in prices or other conditions in a constantly changing marketplace. The most common types of derivatives are options and futures. Derivatives are typically leveraged, which means you can control a large asset with a much smaller amount of money. Leveraged securities are often the preferred tools of traders who want to speculate because they are more capital efficient. Capital efficiency is the idea of maximizing the return of a position without tying up a large amount of cash. But with the increased potential reward of capital efficiency also comes increased risk. A position is simply a term to describe an investment into a specific security. For example, an investor might own 200 shares of Apple and then decide to increase his position size to 400 shares because he is increasingly bullish on the stock. His position can also be described as a bullish position because the investor will benefit from increases in the value of Apple. Lastly, I just want to point out the difference between investors and traders. Investors typically have long time horizons and are not looking to cash out of their investments for years or decades to come. Most investors will buy into the market slowly and hold their positions indefinitely, only selling when their underlying outlook on a security changes significantly or when they need to rebalance their portfolio. Traders, on the other hand, are much more active and tend to make multiple transactions on a weekly, daily, or hourly basis. Traders help to increase trading volume and provide liquidity so that long-term investors can easily buy and sell assets at fair prices. Alright folks, that's all I have for you today. If you found this helpful or have questions on other investing terms, let me know in the comments below. I'm planning to take the day off tomorrow to celebrate my birthday, but after that, the next few videos I'm working on are investment account types, passive versus active investing, and how to pick stocks. If any of those topics interest you, then please hit the like button and subscribe. Until next time, keep calm, stay healthy, and happy trading.